Hello, welcome to this deep dive into the wisdom of the legendary investor Peter Lynch. Today we're tackling a question sent in by one of our listeners that I think gets right to the heart of a major concern for many people. They wrote, "I'm in my 50s now. Both Peter Lynch and Warren Buffett said investing is all about giving it time. But with retirement getting closer, I feel like time isn't on my side. Does that mean investing in stocks is no longer a good idea for me?"
Yeah, that's a really common and frankly a very smart question to be grappling with when you're in your 50s. It really is.
It makes perfect sense, doesn't it? That feeling of urgency.
It's completely natural. You look at the calendar, retirement feels like it's just around the corner, and you wonder,
Yeah.
have I missed the boat on stocks?
Absolutely.
Good.
You spent decades building towards this phase, and retirement feels, well, tangible. The idea of putting hard-earned money into something that can go down,
Especially when you feel like you only have maybe 10 or 15 years left.
right? It feels risky. You
Yeah.
think you need stability, not volatility.
Precisely. And our mission in this deep dive is to explore that exact feeling that time isn't on your side in your 50s and see what Peter Lynch's principles and the source material we've looked at tell us about it.
And I think the key takeaway we'll uncover is going to be surprising for some, because the answer, based on what we're seeing, is likely the opposite of that gut feeling. 50 isn't too late to start investing or to invest more significantly. In fact, it could be the most important time to get serious about it.
Okay, let's unpack this. The very first thing we need to do, as the source material suggests, is challenge the fundamental premise of the question itself
How so?
by redefining what time actually means for an investor in their 50s.
Right, because when someone in their 50s says time isn't on my side, they're usually thinking,
They're thinking, I retire at 65, maybe 67, so I only have 10, 15 years until I need the money. They see that retirement date as the finish line for their investments.
and that's the crucial mistake, isn't it?
It's a critical misconception. In today's world, retirement isn't the finish line. It's just a major milestone, maybe a transition point.
Yeah.
With increasing lifespans, someone retiring at 65 could easily live well into their late 80s, 90s. Even beyond 100 is becoming more common.
Wow, so that's potentially another 20, 30, even 40 years of life that your
Wow.
money needs to support you.
Exactly. The money you're managing in your 50s isn't just for the next decade. It's money you potentially need for the next 4 or 5 decades.
That completely changes the time horizon calculation, doesn't it?
It absolutely does. Think of being 50 not as being close to the end, but potentially being right around the halfway point of the period you need to manage your finances for.
Halfway. That's a very different perspective.
And you need that money to not just last, but to maintain its purchasing power and ideally grow throughout what could be a very, very long retirement.
Okay. And when you look at that much longer time frame, the biggest threat shifts, doesn't it? It's not really about those short-term market dips over a few years anymore.
Exactly right. Over a 20, 30, or 40-year period, the biggest enemy of your retirement savings isn't market volatility. It's something far more insidious.
Inflation.
The silent, relentless erosion of your purchasing power by inflation, that's the real danger over the long term.
And this is why Warren Buffett, as quoted in the source, famously said that deposits are the worst investment. Is that right?
That's a powerful statement, isn't it? Coming from him. Keeping all your money in cash or standard savings accounts might feel safe because the dollar amount doesn't go down day to day.
Right, looks stable.
But every single year, inflation means that same amount buys less and less. The source gives a really stark example.
Along with that.
Think about having, say, 100 million won equivalent maybe to around $75,000 USD today just sitting in a bank account.
That
Due to inflation, in 20 years, it might only have the purchasing power of, what, $50,000 or $60,000 buys today?
That's incredible. So while you're trying to protect against a potential temporary market drop,
You're practically guaranteeing a significant loss in real value over time just by staying in those supposedly safe places.
that's the trap.
It really is. And it's why investing in assets like stocks, despite their inevitable ups and downs in the short term, becomes one of the most crucial tools you have in your 50s.
To actually outpace that inflation.
Exactly. Over the long horizon of your entire retirement, stocks offer one of the best chances to grow faster than inflation and protect the real value, the actual purchasing power of your savings.
Okay, so we've got it. The time horizon is longer than we think, and inflation is the real enemy. How does Peter Lynch's wisdom help us navigate this, specifically in our 50s?
Well, Lynch's principles are remarkably well suited for someone feeling that time crunch or, that anxiety about market timing. His most fundamental advice, which the source highlights, is crystal clear.
Which is?
Don't try to predict the market. Study companies during that time.
That feels incredibly relevant right now. When retirement is getting closer, there's this huge temptation to try and time things perfectly, get in at the bottom, get out right before a crash.
Oh, absolutely. That anxiety often leads people down the path of trying to market time, which Peter Lynch thought was basically futile and counterproductive.
He had a quote about that, didn't he?
He put it very bluntly. The source translates it as, investors lost far more money waiting for market crashes than they lost in actual crashes.
Wow. Just think about that. The cost of sitting on the sidelines waiting for the perfect moment
Is often much higher than the actual pain of weathering a market downturn, assuming you're invested wisely for the long term.
So the takeaway from Peter Lynch here to the investor in their 50s is
Ignore the urge to forecast recessions or predict the next bubble. Forget about it. Instead, redirect that energy into his core principle. Understand what you own.
know the companies.
Yes, study stable, profitable companies, businesses that are resilient, that have solid foundations, that can navigate economic cycles over decades. And ideally, companies that share their success with shareholders through dividends.
So definitely not chasing speculative trends or, those meme stocks we hear about.
Oh, absolutely not. That ties directly into another key Peter Lynch principle the source mentions. The stock you own is not a lottery ticket, but a part of a company.
I love that perspective. It completely shifts your mindset from gambling to ownership.
And in your 50s, this is vital. This isn't the time for hoping for a quick IO, hitting that sudden jackpot. It's the time for owning pieces of solid, reliable businesses that generate real profits year after year.
What kind of companies does the source suggest focusing on at this stage, sort of applying Lynch's ideas?
Well, drawing from Lynch's own categories and thinking about what's suitable for someone focused on stability and long-term income potential, the sources point towards a couple of areas.
Okay.
First, large-cap quality stocks, what Peter Lynch called stalwarts. Stalwarts.
Okay.
These are your large, established companies, strong balance sheets, leaders in their markets. Think household names known globally for their resilience and consistent, even if not explosive, growth.
Like,
The Coca-Colas, the Johnson & Johnsons of the world, or a major player like Samsung Electronics in the Korean market example. These are companies built to weather decades.
makes sense. And the second type?
Dividend growers. Companies with a proven track record, a history of consistently increasing their dividend payments over many, many years.
And how do those dividend growers specifically help someone getting ready for retirement?
Well, they can provide a growing stream of income in retirement, almost like a potential future monthly salary from your investments. An income stream that often exceeds bank interest rates.
Plus, you still own the stock.
Exactly. Plus, you still benefit from the potential appreciation of the stock price itself over time. It's essentially a way to get paid to own a good business, and that income stream can grow, helping combat inflation during your retirement years.
Okay, so we've reset our understanding of time, identified inflation as the real threat, and learned how Peter Lynch's focus on understanding businesses, not timing the market, is absolutely key. What does a realistic investment strategy actually look like for someone in their 50s based on all this?
Right. The sources emphasize a strategy focused on diversification and stability. Definitely not going and, putting all your eggs in one basket or chasing one speculative stock. Your goal actually shifts from just pure aggressive growth
to something more balanced.
Exactly, more balanced. If your 20s and 30s were maybe all about maximizing growth, your 50s should probably prioritize three things.
Okay, what are they?
1, asset preservation, protecting the capital you've worked hard to build. 2, consistent cash flow generation, thinking about those dividends providing potential income later on. And 3, moderate growth.
Moderate growth. Why moderate?
Crucially, enough growth to beat inflation and maintain your purchasing power over those long retirement years. It doesn't have to be spectacular growth, but it has to outpace inflation.
Preservation, potential income, and beating inflation. That framework makes a lot of sense for this stage.
And before you even think about allocating significant money to stocks, the source stresses a really crucial first step.
Which is?
Secure a safety buffer. You need to have 3 to 5 years of your estimated living expenses set aside in easily accessible, genuinely safe assets.
Like savings accounts or very short-term bonds?
Exactly. Cash, high-yield savings, maybe short-term government bonds, things that won't drop in value when you need them.
Why is that buffer so critical?
It provides an essential psychological safety margin. Think about it. If the market takes a big downturn, which it inevitably will at some point.
You don't want to be forced to sell.
Precisely. You won't be forced to sell your stocks at a loss just to pay your bills or handle an unexpected expense, especially once you're actually in retirement. You can live off that buffer while your stock portfolio has the time it needs to recover.
It stops you from panic selling at the absolute worst possible moment.
Exactly. That peace of mind is invaluable.
Okay, so buffer in place. Now, how should the stock portfolio itself be structured?
The sources suggest a structure that heavily prioritizes stability. The core of your portfolio may be, say, 70% to 80% of your stock allocation.
The biggest chunk.
Right. Should be in diversified, stable assets.
Like broad market index funds or ETFs, you mentioned those earlier.
Exactly. Funds that track major indices like the S&P 500 or perhaps diversified global dividend growth ETFs. This approach simplifies things tremendously.
Less stock picking needed.
Much less. It reduces the risk of picking individual losers, and it ensures you participate reliably in the overall growth of the market over the long term. It's a stable foundation.
And the remaining 20 or 30%.
That smaller portion can be your ancillary allocation. Maybe for a few individual quality stocks or dividend-picking stocks that you know exceptionally well that you've really researched, following Lynch's principles.
So a smaller bet on specific companies you understand.
Yeah, this is where you can potentially aim for slightly higher returns, but the stability of that large core ETF portfolio provides the essential foundation.
Okay, so putting it all together, investing in your 50s isn't some last desperate sprint before retirement.
Not at all. It's more like preparing for the crucial second half of a long-distance marathon. That's how the source puts it.
The second half, I like that.
You need to kind of discard that impatience that comes with feeling the time crunch and approach it with the mindset of partnering with sturdy companies that will see you through the next 30 or 40 years.
Ignore the market noise.
Just focus on being a shareholder of good businesses you actually understand. When you approach it wisely, stock investing in your 50s it's not unreasonable or excessive. It's actually a crucial state, a powerful ally to protect your retirement assets from inflation and help ensure they last as long as you do.
That framework makes a lot of sense, especially if someone has managed to save a substantial amount. But the listener's follow-up question was really sharp, and it zeroes in on a very common situation. They asked, doesn't dividend income require a significant lump sum? If I'm over 50 with no lump sum and minimal dividend income, is there a reason to invest in stocks?
That's an excellent, very realistic question. It perfectly captures that feeling that, if you're starting small later in life, maybe it just won't make enough of a difference to bother.
Yeah, exactly. If the dividends are only going to be, pennies or a few dollars, what's the point of even dealing with the market ups and downs?
The source addresses this head on. And it says that for a 50-something investor starting with a smaller amount, the goal is absolutely not about generating income to spend right away. That's simply not the immediate purpose.
Okay, so if it's not about immediate income, what is the goal then?
The real goal, as the source explains it, is to start rolling the asset snowball. The focus is on the growth of the asset itself.
Rolling the snowball, like the compounding effect.
Precisely. Even a small snowball, when rolled consistently down a long hill, can become very, very large over time.
Okay, but how does that asset growth actually work if you don't have a big lump sum to get the snowball rolling initially?
The source provides a really concrete example. It compares two people, let's call them Alan and Ben. Both are 55 years old.
Okay.
Both start with the same amount, $25,000. And both commit to saving an additional $500 per month for the next 10 years until they turn 65.
Okay. Same starting point, same savings habit. Let's look at Alan first, the cautious saver.
Alan is risk-averse. He's worried about losing money in the market. So he puts his initial $25,000 and every single $500 monthly contribution into a high-yield savings account. Let's say it earns a steady but pretty modest 2.5% annual interest.
Okay, safe but low return.
Right. Over those 10 years, his total contributions are $60,000, $500 times 120 months, added to his initial $25,000. That's $85,000 in principal he put in.
And at age 65, after 10 years,
Alan has grown his money to approximately $101,000. He's preserved his capital, definitely, and earned some interest. Not bad, but...
Okay, now let's look at Ben, the investor starting small.
Ben also starts with $25,000 and saves the same $500 a month. But he decides to invest his money. He puts it into a diversified S&P 500 ETF aiming for long-term growth. The source uses a fairly conservative estimate of a 7% average annual return for the ETF.
And what's his key strategy? especially with the small dividends he might receive.
This is the crucial part. Ben's strategy, as the source describes it, is not spending a single dollar the dividends received, but reinvesting them as they are to buy even one more share of the ETF.
Okay, so he doesn't touch the dividends at all. They just automatically buy more shares.
Exactly. He's not seeing those dividends as income to spend. He's seeing them as fuel for more growth.
So that activates his growth engine, as the source calls it.
Precisely. There are a few things happening for Ben. First, the value of the ETF shares he owns grows over time. That's capital growth. Second, the small dividends he receives automatically buy him more shares. That's the compounding effect starting.
Got it.
Third, because he now owns slightly more shares, his next dividend payment will be slightly larger. And fourth, that slightly larger dividend buys him even more shares.
Accelerating the snowball effect.
Exactly. It starts small, but it builds momentum.
So what's the result for Ben at age 65? After those same 10 years.
Despite starting with the same amount and saving the exact same $500 a month, Ben's investment has grown to approximately $138,000.
Wow. $138,000 compared to Alan's $101,000. That's a difference of $37,000.
A really significant difference, isn't it? Just from deciding to invest and, crucially, reinvest those dividends, even starting relatively small and saving modestly each month.
What did the source say made that difference?
It highlighted that the core difference was simply whether the growth engine was started. Did you put your money to work in a way that allowed it to compound and grow on itself?
So for Ben, that investment he made in his 50s wasn't really about generating income he could spend right away.
No, not at all. It was the initial force, as the source put it. The push needed to start rolling his assets snowball down that steeper compounding hill. And that snowball, nurtured diligently for 10 years, became considerably larger than Alan's by age 65.
So back to the listener's question. Is there a reason to invest if you're over 50, have no big lump sum, and expect minimal dividends initially?
Absolutely. That $37,000 difference is the reason. Think about it at age 65. Alan has $101,000. He's likely facing anxiety that any withdrawals will quickly eat into his principal, especially with inflation continuing.
Whereas Ben
has $138,000. That larger asset base is far more likely to provide what the source calls meaningful retirement income, whether through more sustainable withdrawal rates or eventually larger dividends from a much bigger capital base. And his capital is better preserved for longer.
So the point of those small investments in your 50s is really about growing the asset itself through compounding and reinvestment.
Yes.
To build a much larger base that can provide meaningful income or stability 10 or 15 years down the line.
You've got it exactly. And the sources make this absolutely crucial point. If you decide not to start investing now in your 50s because you feel you don't have a lump sum,
you'll likely be in the same boat later.
You are setting yourself up to be in the exact same position 10 years from now at 65 or 70, saying, well, I still don't have a lump sum, so I guess I can't invest. Starting small, even in your 50s, is often the only way to build that asset over time.
This naturally brings us to that point our listener raised about Warren Buffett. They asked, come to think of it, Warren Buffett's 90% of assets were earned after his 60s, right?
Yes, you are almost exactly right about that fact. It's a statistic that gets mentioned a lot in investing circles. And for a 50-something investor, it really shouldn't be a source of feeling like it's too late. It should be seen as a powerful symbol of hope.
What are the precise numbers? Does the source mention them?
Yeah, while the exact figures can vary slightly depending on how you calculate it and when, it's widely accepted, and the source confirms this kind of range, that something like over 99% of Warren Buffett's current massive wealth was accumulated after his 50th birthday.
99% after 50.
And perhaps even more staggering, something like 95% of it came after age 65.
95% after 65. That's truly astounding.
It really is. And as the source notes, the listener's observation is spot on. This fact perfectly supports the idea that for an investor in their 50s, even someone who isn't already a billionaire, obviously the most significant growth phase could very well still be ahead.
If you have an asset base that is compounding.
Exactly, if you've got that snowball rolling.
Why is this statistic so important, so hopeful for someone starting or maybe getting more serious about investing in their 50s?
Because people often see Buffett's immense wealth and sometimes make the wrong assumption. They might think he was just, born brilliant, or maybe that he only got super rich very late in life because of some sudden massive investment success right around age 60.
But that's not the story at all, is it?
Not even a little bit. Buffett's wealth is the ultimate textbook example of the compounding snowball effect we just talked about with Ben, just on a much grander scale.
He started early.
He started rolling that tiny snowball very early, back in his teens. It grew steadily, consistently, through his 20s, 30s, 40s. By his 50s, it was already a substantial, fast-growing snowball.
Yeah, I did it.
And then in his 60s and beyond, that's when it became a massive, accelerating avalanche. The growth became exponential.
Which means his incredible wealth accumulation after 60 wasn't some new phase. It was the direct result of decades of consistent effort and compounding leading up to age 60.
Precisely. His 50s weren't the time he suddenly figured it out. They were the time his already significant snowball was hitting the steepest part of the hill where compounding really takes off. A critical point where growth just goes vertical.
Right. The growth isn't a straight line. It's a curve that gets steeper and steeper over time.
Exactly. Doubling your money when you have, say, $1 million happens much faster in absolute terms than doubling it when you only have 1,000. And doubling it when you have hundreds of millions happens incredibly fast. That's the power curve.
So for someone in their 50s, stopping investing now or not starting is kind of like stopping just as the most powerful phase of that compounding curve is about to really kick in.
The source uses a couple of excellent analogies for this. It's like spending hours carefully tending a campfire, nursing those little flames, only to walk away just moments before it finally erupts into a roaring blaze.
Or the snowball analogy again.
Or pushing that snowball patiently up the first gentle slopes and across the flat parts, only to stop right before it reaches the steepest part of the downhill, run the part where it will gain mass and speed exponentially, almost on its own. That steep part, the degenerate or explosion phase, that's where the real magic of compounding happens.
And the 50-something investor, maybe like Ben with his growing ETF portfolio, is standing right there with a decent-sized snowball right at the top of that steepest slope.
That's the perfect way to frame it. You are entering, or perhaps are already in, the phase where your asset base has grown enough that compounding can start having its most dramatic effects. Quitting now means abandoning the whole process just before the potentially fastest growth period is likely to occur.
Let's revisit Ben's example quickly, but extend it out. He had $138,000 at age 65. What happens over the next 10 years, say, at age 75?
Okay, if Ben simply left that $138,000 invested, didn't add another penny, but let it continue to earn that conservative 7% average annual return with dividends reinvested, by age 75, his asset would grow to approximately $271,467.
Okay, hold on. Let me process that. In the first 10 years, from 55 to 65, Ben turned his 25K start plus his 60 towers and savings contributions into 138K. So the growth plus the savings was about 113K total increase.
Right.
But in the next 10 years, from 65 to 75, with zero new savings added, his money grew from 138K to 271K. That's an increase of roughly 133K.
See how powerful that is? The growth in the second decade, fueled purely by compounding on the larger base he built in the first decade, was actually more than the growth, plus all his hard-earned savings contributions combined in that first decade.
That is a perfect little illustration of that accelerating power, just like with Buffett.
It absolutely is, and that's exactly what allowed Buffett's wealth to explode after 60 decades of prior compounding reaching that critical mass.
So the Warren Buffett fact isn't saying, oh no, you should have started 30 years ago.
Not at all. It's saying, as the source puts it so well, the most explosive growth in your investment life can start right now.
Because you've potentially reached that steeper part of the curve.
Yes. History, demonstrated by extreme examples like Buffett and much more relatable ones like our hypothetical Ben, proves that a very, very significant harvest is absolutely possible in your 60s and 70s, precisely because you started or continued consistently rolling that snowball in your 50s.
Okay, this has been incredibly insightful. Let's quickly recap the key takeaways from this deep dive for someone in their 50s asking that initial question. First, redefine your investment time horizon. It's not just until retirement day. It extends potentially decades throughout retirement.
Second, recognize that over that long haul, the biggest threat isn't short-term market bumps. It's the steady erosion of purchasing power by inflation. And stocks have historically been a necessary tool to combat that.
Third, embrace Peter Lynch's fundamental wisdom. Forget trying to predict the market. It's wasted energy. Instead, focus that energy on understanding the solid businesses you own or are considering owning.
Fourth, remember that a stock represents owning a piece of a real company, not just a lottery ticket. In your 50s, the focus should be on stable, quality companies. Perhaps those stalwarts or reliable dividend growers.
Fifth, set realistic goals for this stage. Asset preservation, yes, but also thinking about potential future income generation. And, crucially, achieving moderate growth to beat inflation. And absolutely secure that 3 to 5 year safety buffer in cash before investing significantly in stocks. Structure the portfolio around a core of diversified, stable assets like broad ETFs.
And sixth, and maybe most importantly for those starting smaller, understand that the primary goal of investing in your 50s, especially without a huge lump sum, is initially about starting or accelerating the growth of the asset itself through consistent investment and reinvesting any dividends. That asset snowball needs time to grow before it can provide meaningful income or stability, maybe 10, 15 years down the line.
It really underscores the sheer power of consistency and compounding, starting from wherever you happen to be right now. It's
Yeah.
never too late to start that role.
Absolutely. And if we want to say a word from Lynch today and say that this principle is connected not only to investment decisions, but also to life wisdom, let's maybe circle back to his core idea we discussed. The stock you own is not a lottery ticket, but a part of a company.
Okay. How does that connect to broader life wisdom?
Well, think about it. It's really about the value of building something real, something sustainable, through consistent effort, patience, and genuine understanding, rather than just hoping for a sudden lucky break.
Like building a career or a skill.
Exactly. Or a strong relationship, or even your own knowledge. It speaks to delayed gratification, investing your time and energy into building a solid foundation now, owning your part in something meaningful, nurturing it, and letting it grow steadily over time. True lasting value in life as in investing often comes from that steady building, that ownership, not from just gambling on quick wins or lottery tickets.
That's a really profound parallel. Don't just chase the lottery ticket. Focus on building the business, whether it's in your portfolio or in your life itself. Okay, so maybe a final thought for you, our listener, to ponder. Considering this immense power of compounding, especially as you approach and move through retirement, and remembering that potentially very long time horizon, what's just one small, consistent step you could take, starting today, to begin building or strengthening your own asset snowball? Because history, and certainly the wisdom of Peter Lynch, strongly suggest that the most explosive growth might still be ahead of you.
It really is true. It's never too late to plant that seed, especially when you understand that the potential harvest season might stretch out for decades into the future. Give it time to grow.
See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.